Welcome to the Bold Property Podcast, where informed decisions shape stronger property portfolios. Your hosts are Karl from the Barnard Group and Cameron from The Way to Invest. Each week they cut through the noise and guide you to invest with clarity, strategy and confidence.
So Cam, we're back for the second episode of the Bold Property Podcast. I've been out and about this week and the market in Brisbane is absolutely crazy. There's first-time buyers everywhere and they are throwing silly money at properties and making some risky decisions. I see that as something we would need to navigate for a bit of time to come. But, temperature's heating up, market's heating up. It's really, really busy where I am. How's your week been?
Yeah, look, I'm very similar, and having discussion just before about how prices are growing so quickly. Different areas are doing different things, but overall, yeah, as you said, all these first-home buyers getting into the market is putting pressure on investors as well to, up prices. And are you going to start getting that return on investment? How long is this going to go on for?
Having some interesting conversations with some real estate agents where they can't even believe what's happening. What I'm finding is they are now not giving out price guides because they don't want to anchor a property at a potentially lower price point. And I'm also seeing a lot more prevalence of auctions coming up because, again, they're struggling to put a number to this. And yeah, there's so much money entering the market. I mean, I'm assuming you would have seen the news, but I think month of October was the fastest single monthly increase Australia-wide for property prices. I think November is probably gonna beat that by some margin. It's certainly lit a bit of a rocket under the property market, and every state has its own limit. It's certainly we're into the next phase of growth. The question is, how long is that going to last?
I think we touched a bit this on last week, and it was about the supply and demand. And, and there's still no supply as there is from last week to this week. And there's still a lot more demand, and there's a lot more increasing demand, which is going to, again, just continue to increase prices. And as you said, the first home buyers grants, they can be up to excess of $1 million. And is that where we're going to be sitting at some capital cities, is that your medium house price is $1 million because that's all we can get into, and that's where the first home buyer cap is. And then after that, does that mean that they're going to introduce new schemes to get more people into the market?
It's going to be really, really interesting to see how this plays out. We're also in the lead up to Christmas, and I think there's a lot of buyer psychology playing into it as well. A lot of people want to try and secure something before Christmas, before they switch off for the year. So I think it's going to be interesting to see whether we're having this bump up now and whether it's going to not go back to normal levels, but something a bit more level in the new year, and whether the lead up to Christmas is sort of, is that last push, seeing some silly numbers in the market. So I'm really keen to see whether that's going to roll over into the new year or whether people are going to go, actually, I've got a bit more time now. I don't have to throw out silly numbers on properties. And look, that remains to be seen. The other thing I'm sort of seeing in the market as well is, especially with first-time buyers, just some of the risky buying behavior, in addition to what we're seeing in terms of money they're throwing at properties, is really just some of the terms around contracts. Some of the risky behavior I've seen is they're buying into properties that have a lease longer than 6 months. Well, that's going to affect their stamp duty concessions that they get. I'm seeing them buying properties where a building pest inspection report had been provided. Now, I know you always do your own building pest inspection report. That's the only guarantee you have when you buy that property. And what a lot of people also don't realize is if you get given a building pest inspection report, and if it turns out that, what's in there, they missed something and there's a major issue with the property, if you are not the person who actually bought and paid for that report, you've got no coverage in terms of insurance. So to me, it's almost like buying it blind, right? What I'm also seeing is agents going, oh, well, if you want to do your own building pest inspection report, we might not consider your offer because we've got other offers that don't ask for that. And I mean, we're going to talk about markets and how they move at different times, but I had an instance where, we were given a building pest inspection report. We insisted on doing our own. We did our own, and we found an illegal structure on the property. And this was like a big single garage. expensive structure. That was never, it never came up in the initial one. So yeah, a lot of risky buy behavior going on. Look, I think a couple of people might look back at this and go that they were burnt. It's going to happen. There's going to be stories of buyers who've been burnt. So I think the market's nuts, but I think a word of caution to any buyers out there is do your due diligence, make sure you buy with your head and not your heart, or at least a combination of the two, because there's a lot of heart buying going on, a lot of fear of missing out, a lot of competition from other first-time buyers. People sort of get emotional and they got revved up and they start throwing silly numbers and making some risky decisions.
Yeah, and I totally agree with you when it comes to beauty and pest because, we want to make sure that when we have our clients that we have the best foot going forward and that it's not going to cost you in the long run. You can buy a property and yes, you can get some money taken off it if you negotiate that through your terms and conditions. But if you're getting it sight unseen, you don't have a leg to stand on.
Yeah, absolutely. So I think for a weekly wrap up on, what's happened in the last week, I think this is certainly where we're at. And I think this time of year, people also need to think about settlement timeframes running into Christmas. What are you going to do around that? Check with your mortgage broker. Is the bank ready to settle if you're close to Christmas? What are shutdown periods? Have a chat to the solicitors. Are they shutting down? Just make sure that you don't end up with a settlement date that you can't meet. So, but the topic of today's conversation is about the Australian property market and how the market moves at different speeds. Now, we know it's moving really quickly, just sort of everywhere, but, that's not always the case. I think the conversation really today is going to be about, well, Australia isn't just one single property market.
It's definitely not. We got multiple markets and there's markets within markets. It's a very popular saying when we're talking about property, and the markets are different in different states and even different regions, even different suburbs, really. Had the opportunity to go to Ipswich a couple of weeks ago, and it was mind-blowing, the pockets of the same suburbs. I was in one particular suburb and I went to one open home and the price of the houses was very similar, but just around the corner, it was just completely different price brackets, and both were very, very popular open homes. There was quite a lot of potential buyers going in there. But yeah, it was really interesting. The same value of a house in northern Ipswich compared to like inner city. We've got different types of houses. It was a 2-story house. It was a well-presented house. And then we went to a beautiful Queenslander in town of Ipswich, and both 900,000. I was just trying to work out the comparisons of it all, but both sold very quickly, and both great properties. But it was just the transparency of both. It was just completely different.
That's and I think is a good point. You're touching on that on a micro level, right? But if we sort of zoom out a little bit, the big capital cities always make the news when markets start running hot, and sometimes the ones that are underperforming make the news, but the media loves to chase the ones that are doing well. And I think a really good example of that would be if we just think of it over the last year, where an area like Brisbane has been doing really well, more so, over the last 12 months, but even for a longer period of time, for a number of years, sort of since 2020 is when things started taking off. But at the same time, when you looked at the Melbourne market, it was almost the polar opposite, where that market absolutely just stalled out. Nothing happened. And there's a couple of reasons for that, which, we don't have to get into, but it basically just comes down to there was a significant amount of demand in the Queensland market or Brisbane, and there wasn't much demand in Melbourne or Victoria. I think for anyone listening, it's important to understand that just because Brisbane's doing well doesn't mean Melbourne's doing well, or Sydney or Perth or regional areas. And different markets have different cycles. And the property market in general, it does go through cycles. If you've sort of seen the property clock, search that up. But it's not always the same market. And there's a lot of nuance when it comes to investing and sort of thinking about the different market movements.
Yeah, that's right. And it's about trying to read the data properly too, because when they do release the data and they said, we've had a national growth of, say, 1% or 3% in the last quarter, but we've had, 2% in Brisbane and -4 in Melbourne. These are just made up numbers, but it's a national average. But it's just those actual capital cities you've got to look at. But then once you look at that capital city, you're looking at an even deeper level on that suburb as well, and that house. And then you've got to do your proper analytical reports to make sure that you've got the comparable properties to make sure that, well, this is actually fitting in with what we've got. And what is the actual projection of what this property can make you? And this is on an investment side, I guess. So yeah, just looking at the actual growth is very comparable with different places, whether it's cities, regional, markets, what we're looking at and what's the best place for your affordability for you to buy into.
I had people sort of come to me, when they were looking to buy a property in Brisbane, and they named a couple of suburbs, and I said, look, it's going to be their owner occ, but they still wanted to grow really well. I pulled the numbers in the suburbs they were looking at, and where the rest of Brisbane had done 20% the last year, those suburbs actually hadn't moved. And, people hear, hey, Brisbane's doing really well. But as you said, different LGAs could have different drivers, and then within that different suburbs and pockets within suburbs. So, you're quite right. It's really understanding the numbers. And I think a lot of people get their information from the media. I've seen this so many times. Over last year, I've done a lot in regional Queensland because just the market was really where my clients were, where we could, to put their budgets into, get some really good growth. And we'd be in a town for about 12 months. We'd be operating across multiple clients. And, you're just playing in the market. Things go well, and it's sort of business as usual. And then an article comes out on real estate, and it says this specific town is doing really, really well. And almost overnight, investors absolutely pile into that market because the only frame of reference they've got is a news article. By the time it hits the news, we go, okay, now we're pulling out, right? Now we're going to write that growth. So I think looking at the news for your investment advice, you need to go a lot deeper than that. I have a saying, once it hits the headlines, it's almost time to go, okay, we're not going to be playing in that market anymore. Not always the case, but you're almost too late to be getting into that market, because one thing the news loves to focus on is historical growth. They might say, hey, this town did 20% in the last year, great place to invest. Well, historical growth figures should be one part of the data set that you're looking at. But I think there's a lot of investors out there making decisions based on historical growth and on what's in the media. And I think last week when we sort of talked about it as well, you need to invest where it's right for you, what fits in with your strategy, what fits in with your long-term plan, not what the media is telling you.
Agree. And it's that good old saying, white noise. And this is, as buyers agents, this is our job to do the due diligence to make sure that you're buying in the right markets. And, a lot of people, I know when you say that word hotspot, like, I think it's way gone once we're talking about that hotspot. We want to talk about the cool spot, or maybe talk about the warm spot before. And the data that you're going to see in your places in like Southeast Queensland aren't going to reflect what's actually could happen in the future potentially. When you're looking at the data compared Brisbane to Melbourne, as completely different data sets, but they're in totally different parts of their cycle.
So let's talk about some of the factors that influence different market cycles. Why do markets move at different cycles? So one of the key things I like to look at is infrastructure investment. And when we look at an area for an investment, we want to have a look at what the future potential is going to be of that specific area. What's going to drive people into the area? That's going to drive growth in the property market. So a lot of the things we would have a look at is infrastructure. Now, infrastructure is a really, really big thing that drives people to certain markets, right? If, for instance, you have a suburb on the fringes of a capital city, public transport isn't great, and all of a sudden a train line goes in that can get people into the city, guess what? More people can start moving to that area. It becomes a bit more popular, and then that would drive price growth. Or if you were to consider a regional town, for instance, if a new hospital goes in, it's going to create 2,000 jobs. Guess what happens to that town, right? More people move in, there's job growth, and there's pressure on property markets going up. And I think you sort of touched on WA as well about, yeah, WA to a degree is linked to mining. That economy has diversified a lot more, but it does have its swings and roundabouts, especially there's macro and microeconomic factors that would influence that. And the same goes for in an area like Melbourne. That's sort of just, that was flat for quite some time due to the rules the government brought in around investors and land tax, and that sort of kept prices down a bit more.
Yeah, and that's right. Like, there's certain things that I look at for infrastructure. So, for example, a big one is a hospital. So you got a new hospital coming in Melton, you got a massive new hospital coming in Toowoomba. But when I look at that, I look at, okay, we need people to build these hospitals. So you've got jobs coming in there, which is increasing population. But then when you're building a hospital, you also need people to work in that hospital once it's completed. So yes, you've got your nurses and you've got your doctors, but then you've got your catering staff, your allied health staff, your management, all that. So that's a big influx of, potential population growth. And that's another factor that we look at as well, is that potential growth that's going to happen into these areas, which is going to be another driver to increase property prices. Another one I like is train lines. So for example, the inland rail, and every area that this new inland rail is bringing in is growing that population or growing that suburb capital growth by a significant amount.
Yeah. I mean, I think you've got some great insights into the medical field, don't you? Just based off your background as well. And I think you touched on it's the hospital, but you get a lot of services that are hospital related that would then set up offices in and around the hospital, like the allied health professional. So that's a very, very good point. It's not just the hospital, in and of itself, but it enables additional businesses that are related to the medical and health field to sort of set up around that. So I think if we were to touch on, certain markets and use it as an example, right? If I were to use Brisbane as a market, where I would say before 2020, if you look at the market in Brisbane, like the decade before then, you could buy and sell a property for exactly the same price. Nothing happened in Brisbane, right? And, what happened is COVID sort of kicked off. It created a work from home opportunity for a lot of people. And it also created the opportunity for people to sort of think about life and what they want to do and where they want to live. And I think Brisbane had been overlooked as a capital city market for quite some time. And what happened is people thought, oh, hang on, I now have the opportunity to keep my job. I could move to somewhere like Brisbane, where comparatively on the eastern seaboard, prices are very, very low. And what we saw was all of a sudden people from Melbourne and Sydney, with their Melbourne, Sydney jobs, income, and sort of mindset around what properties are worth, came in. To them, they bought a bargain, but you just had a massive amount of interstate migration coming into the city, great lifestyle spot, and that just drove up property prices. Where now, Brisbane is the second most expensive capital city in the country, just behind Sydney. A lot of people ran away from Melbourne. I was one of them. I'll put my hand up. I chased the sunshine.
That was right.
It makes two of us. But that's one reason why the Brisbane market all of a sudden just grew. And we're still seeing a lot of interstate migration coming into the state. But do you want to talk us through what's happening in Melbourne at the moment and why we're starting to see some growth returning to that market?
It's a population driver, but it's the affordability. I think that's the biggest driver at the moment. So, we're all getting a lot of people are getting priced out of the market, and especially when it comes to investing, you want to sort of be at that bottom of that cycle. And I think that's where we're at right now with the Victorian market. And, you've got your regional towns like your Bendigos, your Ballarats, but there's other places where it's heating up a lot, like your Geelong region. Everyone is starting to talk about Geelong, but I still think there's quite a lot of growth. There's lots of also, projection of population to be put into that region. So it's affordable as well, but prices are going up quickly. There's lots of competition now because I know there's lots of talk about buyers agents getting in there. We had a recent discussion even about Wagga and that the prices are going up there. And sometimes the activity and how things are going about it isn't always the best, and that's what's people are getting priced out as well. Then you've got other regions like, your Albury-Wodongas, which has always been on that par with Melbourne, I found, in that overall average of year-on-year growth. But as I mentioned, the affordability for Albury-Wodonga is nowhere near as same as it is for most parts of Melbourne, but you've just got that long-term growth. So a lot of people are getting in there. Then you've got regions like Gippsland and Latrobe Valley, where you've got lots of infrastructure coming in due to the fact that, the government has allowed that spending for the Commonwealth Games to come in. There's a new university going out there. And when I was on the ground there chatting to the locals, I think it was only a couple of years ago that they had, I think it was 4 trains a day going from Melbourne to Gippsland region. But now it's up to 43 a week. So that just shows the projection of population due to the affordability and potential growth that's going out there. And if you take a drive out there, getting out to Pakenham, going towards your Druin and Warragul, the gap's getting a lot closer. There's a massive freeway that goes all the way out there. So, people are moving out that way. I believe that there's a Costco going out in Pakenham. Don't quote me on that. And that's a closer area to that region. So, Costco don't just build anywhere. It's a big factory. It's a big outlet, and that they see potential in the area as well.
Yeah, like the likes of Costco and Aldi, those big shops that go out, they do their research.
Right.
Cost them millions of dollars to put that up, and they don't put that infrastructure in unless they've got a population or a coming population that could service that. So it's actually one of the good things to look out for, especially when you start considering smaller regional towns, is what are the big box stores are out there. That gives you a good indicator. But the other thing as well is when you consider these new markets, right? We're sort of talking about getting in early into the market. Now, when there's a lot of infrastructure spending, what I like to do is take that as part of the fundamentals, but I also don't want to be the first mover. I don't want to bet on a market that hasn't started showing signs of just moving. And maybe that's just me personally, right? I don't want to be the person to go, okay, I see the research. I want a validation in the market where we start seeing that uptick in more sales of properties, more demand, shorter days on market. I like to see the movement to start before we jump in. I don't want to jump in and then there's no movement coming down the track, right? So I think one of the key takeaways is, you really need to consider where you want to invest. And I think I see so many people just using the media. We've touched on that, but to me, that's a big thing. It's about doing your homework, being really specific and really diving deep into the data to ensure that you get into the market that really works with your budget and where you want to invest, right? Not just following your friends into a market. And I think one of the key takeaways as well is just because a market has done well in the past, you need to understand where that market is in terms of its market cycle. And you see this in the share market as well, right? Something takes off and at the top, a bunch of people start piling in, but it's had its run. So, and I also think, it's probably another important part of the conversation is about that psychology about where you invest. And I think, again, we touched on this last week, your backyard is not necessarily the best place to be doing it. And that, again, your market might have moved. And because it's moved and it's done moving, well, there might be a better market right now. And look, when we talk about property investing, I always tell my clients, think about it as a decade-long investment, right? If you're going to buy a property, hold it for a decade or even 2. You don't want to be holding it for 3 years. Over that long-term cycles will smooth out. But if you want to build a multi-property portfolio, getting into the right part of the existing cycle could allow you to tap into that equity and move on to your next property so much faster, which has a massive impact over a decade or 2.
Yes, because I'm constantly doing, research and updates on my own portfolio. So I'm tracking it where I'm going. I'm not sure if I touched on this, but I've got a goal that I wanted to reach. I've reached that, but I want to make sure I'm still on that right trajectory. And also to make sure that, potentially down the track, I could sell off one of my investments to then buy something better that's going to allow me better cash flow for when I am ready to retire. So what I've done is I've bought in markets that everyone's like, why would you buy there? And that was Ipswich. That was back in 2021. And then the next purchase was in 2022, was in Melbourne. Why would you buy there? It's a bottom market. We've just introduced land tax. We've just, all the investors are moving out because of this land tax. So it was not a good time to buy there, but I did buy there, and then I've waited because I buy all my properties as a long-term hold, and I'm reaping the rewards now because they're gaining that traction of that capital growth. I've got into that time when it's not the best time to buy in that market. The data research has shown, look, over a long period of time, if you look at it, that's where you are going to make your capital growth. And that's the way to invest, is reading the proper data at the right time of the markets, not getting in when it's hot, getting in before everyone else is, and making sure that you're getting the right due diligence done with that property as well.
It's basically just what we talked about, right? You're not waiting for the top of the market before you jump in. And look, it's going to come with different risk tolerances. I personally like counter-cyclical investments. Watch that cycle, watch it go down, see that bottom. And, personally, I like to sort of start seeing a bit of movement and then get into that market. And that'll be ahead of 99% of other investors. And then be confident in the data in your decision. But, you need to get extremely granular with your research. You need to be very granular with understanding your markets. And I still think there's a lot of people that go, oh, Melbourne's going to do well, I'm just going to buy anywhere in Melbourne. But, you need to understand, your state, your city, your LGA, your suburb, and then potentially even different areas within the same suburb. There could just be different pockets, as you mentioned earlier on. Some areas might be close to the new trendy cafes that are absolutely just going through a revival, where the other part of the suburb might be, for lack of a better word, on the other side of the train tracks, where there's not a revival and it's close to open fields. So you need to, look at the data, but you could also combine that with on-the-ground research, right? Walk the suburb, get an understanding of what's going on, do research, speak to business owners, speak to cafe owners, right? There's so much, due diligence you could do, but I tend to find that a lot of people, especially first-time investors, they save up, they get a deposit, and they just want to go deploy that without doing research. And it could cost you tens of thousands, if not hundreds of thousands of dollars if you don't do your homework. So, I think the key takeaway is, different markets, even down to a street level, and you need to do your homework, and you need to understand those market cycles, because if you're going to hold it for the long term, a lot of it will smooth out. But at the same time, you can do so much better if you get into the right market at the right time.
And I guess we could come to the bold statement of the week, that there is no Australian market, only local ones.
Absolutely. And bold investors follow data, not postcodes or news articles.
Very good, the white noise.
Absolutely, the white noise. There's so much around. So, look, I think, some of the key takeaways is there's different speeds, national versus local, and it can get extremely, extremely granular. And people need to do their homework. That's the best advice I can give them, is do your homework. It'll pay off in the long run.
And if you don't have time to do your homework, get an expert that can. There's lots of experts out there. They are researching the markets all day, every day. They know the best places to buy. They will sit down with you. They'll work out what your strategy is. They'll work out what your affordability is and what your end goal is.
Absolutely. So I think we want to thank everybody for listening to episode number 2. Hopefully we're a bit smoother and a bit better than episode number 1. But I think our goal is not to be influencers. Our goal is to just share valuable insights and actionable insights to property investors and home buyers.
Been great fun, and looking forward to week 3.
Catch you on the next one.
Thanks for tuning in to the Bold Property Podcast. If you found value in today's episode, share it with someone who wants to make smarter moves in the property market. For more insights and support, Connect with Karl at the Barnard Group or Cameron at The Way to Invest. Join us next week as we continue to break down the market and help you invest with clarity and confidence.